Joining us, as we said earlier, Canaccord Genuity Chief Market Strategist Tony Dwyer. Tony, great to have you. I mean, isn't it curious that we got all these calls for recession, and like you, people say estimates are too high, and yet we've had pretty good S&P performance for the last 3 earnings seasons, and we're going into this one pretty hot.
Yeah, Carl, thanks for having me. Of course, I'm not unique in the idea that we're going to have earnings that are too high. Ultimately, this whole thing has always come down to a recession call. And historically, if you look back, it takes, because you're using so much leverage each cycle, and the cash economy is bigger than you think it is, it takes longer once you do invert the yield curve and have those lending indicators go sideways. It takes a lot longer. Remember, when you look for recession, now we're in real time. When you look at it historically, it's using revised data, and it happens, pretty quickly. So, I think this is there's nothing here different than prior cycles, except maybe magnitude.
Right. Now, the bulls would counter by saying companies are getting cost discipline early, right? Corporate dynamism's at work. Forex less of a headwind. Inventories are cleaner. Supply chain is cleaner. Can you knock all of those down?
Well, as the great philosopher Mike Tyson said, everybody's got a plan until you get punched in the face. And the punch in the face in a recession is revenues. Typically, from a macro level, it's not when costs are going up. That doesn't cause the major margin compression. You can't cut costs fast enough when revenues go down. And I think, even those that had not expected a recession or the mystical soft landing, you can't disprove that until you're actually in a recession. So now even the Fed has joined the recession parade. And in addition, there's a not widely followed leading employment index that also joined the recession parade earlier this week on Monday.
Tony, are we talking enough about the plunge in M2 money supply? How meaningful is that to this entire conversation, and what the potential ripple effects could be?
Morgan, it's a great question. We have so many formulas and great quant programs and algorithms and other silliness that we do in this business. I like to think about it as common sense. How does the Dwyer family or the Dwyer business get money? We either get it from the financial markets, you create it that way. You get it from lending or borrowing, or you get it from your earnings. The money supply is a function of the Fed historically dropping rates. Now, people would say, well, of course it's going negative. Look at how much it went up before. And the answer to that is, yeah, we spent it. That's what we do. So that's what created the inflation. It's not all sitting there, or household debt wouldn't be at a new record high, and credit card debt wouldn't be at a new record high when you have, over 20% interest rates. So we've spent that money, but to create growth, to be able to look through the coming economic weakness, you have to have a better outlook for money. We're already at full employment, so that's not going to be the case. The money supply data hasn't changed because the Fed is not lowering interest rates. And the financial markets, believe it or not, they're the same price they were a week ago. They're the same price they were in February, and they're the same price they were last May. So from the S&P 500. So that hasn't given you a lot of extra cash. You've got to have new money to be able to spend money, and the outlook for money just hasn't improved, especially given the H8 data that everybody's quoting from last week.